Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 8th of May. I'm Daniel Lam, your host for the podcast. Yesterday was a very significant day for me. Well, it was my birthday, and I also played my final competitive game of chess before I enter a state of quote-unquote semi-retirement. So what that means is that I will still be involved in organizing events, but I will be cutting down my tournament appearances considerably. Well, this day was inevitable. I had been preparing for this day for the last 2 years because I found it increasingly difficult to be performing as consistently as I once did before. Now, over the last 36 hours, there was also a sense of inevitability in the markets as well. We had a set of announcements from the Chinese government ranging from ensuring liquidity to fostering an environment of technology innovation to shoring up other parts of the economies, such as agriculture. However, the market reaction was buy the rumor, sell the fact, as market had been expecting such announcements. The Hang Seng Index started high and ending at the day low, and the dollar CNH, after hitting close to 6-month low near the 7.18 level, eventually pulled above the key psychological level at 7.20. And this inevitability also manifests itself in the FOMC decision in early Asian hours today. So there was no change in the policies, with the FOMC and Powell indicated that there were uncertainties on both inflation and activities. And this resulted in the relatively muted moves in risky assets post-FOMC, with the market seeing the policy rates that are staying flat and unlikely to be changing in the near future. However, Powell did characterize the current state of inflation as favorable, emphasizing the closeness to the target. And secondly, on activity, he did say that the FOMC could move quickly if there were to be clear deterioration in the data. So therefore, there will be increasing scrutiny on non-farm payroll over the next few months. And to us, a key psychological level would be if NFP drops below 100,000, and also the ISM services falling below 50. Also, of course, the upcoming negotiations between US and China on the trade front would be key to watch for risky assets. Now, over the last 2 weeks, much of the optimism of the escalation had already been priced into risky assets. The fact that China announced its set of stimulus measures ahead of these trade talks this weekend suggests that either, one, there was a sense of urgency in putting forward this stimulus, or two, the trade negotiation would not be straightforward. Either way, this means choppiness in both US and Chinese equities over the next 2 to 4 weeks. We see range trading in S&P 500 between 5,400 to 5,800, and the Hang Seng Index between 21,000 to 23,000. Now, correspondingly, the US 10-year government bond yield would be moving in the 4.1% to 4.5% range. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.